$10,000 in silver, that's the line. Below that, you're a hobbyist. Above that, you're managing real wealth. Mark here from GoFinance. And if your silver position is worth $10,000 or more, whether that's physical bars, SLV shares, futures contracts, mining stocks, anything, and what I'm about to tell you could be the most important 20 minutes you spend this weekend. Because Monday opens in less than 48 hours. March delivery starts Thursday, and the decisions you make or don't make this weekend will determine whether you profit from what's coming or get destroyed by it. So sit down, close everything else, no distractions. This is your briefing. GoFinance, February 22nd, 2026. Before we start, the rules. I sell nothing. I will never sell anything. No courses, no memberships, no signals, nothing. If anyone contacts you claiming to be from this channel asking for money, they're a scammer. Report them. This is educational analysis. This is not financial advice. I don't know your situation. Every decision you make is your responsibility. Verify everything I show you through primary sources. Protect your capital first. Now, here's why $10,000 is the threshold that changes everything. Why $10,000 changes. The game at current silver prices of $84.40 per ounce, $10,000 buys you approximately 118 ounces. But it's not about the ounce count. It's about what that dollar amount represents. Below 10,000, your silver position is essentially insurance, a hedge, a speculation. The dollar amount isn't large enough to meaningfully impact your financial life either way. Above 10,000, everything changes. A 10% move in silver, which happens regularly in this market, represents $1,000 in portfolio impact. The 31% single-day move we saw on January 30th, that was $3,100 per 10,000 of position in one session. If you're holding $50,000 in silver, that January 30th move represented a $15,500 swing. In 8 hours, these aren't hypotheticals. This happened 4 weeks ago. And every single condition that created that volatility is still here. Margin hikes, vault depletion, Chinese export controls now on day 53, Shanghai premiums widening, paper to physical ratios at historic extremes. Nothing improved. Several things got worse. Subscribe to GoFinance if you haven't already. Drop a comment. Tell me the size of your position if you're comfortable sharing. I read every comment. Now let me show you the 5 questions you must answer before Monday. If you're holding $10,000 or more in silver, there are 5 critical questions you need to answer this weekend. And your answers determine whether you survive what's coming. Question 1. Do you actually know what you own? This sounds obvious. It's not. Most people holding 10,000 plus in silver can tell you they own silver. They cannot tell you the specific risk profile of their holding structure. They don't know what they actually own, and they don't know the specific ways that holding could fail. Let me break down every major holding structure and its vulnerability. If you hold physical silver, coins, bars, rounds in a safe at home or secure storage, your risk profile is the narrowest. 0 counterparty risk. No custodian can lend your metal. No exchange can margin call you. No ETF can cash settle your position. No broker can auto-liquidate you at 6:15 on a Sunday night. Your only risks are theft, physical damage, and the opportunity cost of holding non-yielding metal. In the current environment, physical is the safest structure. But it has one critical limitation at the $10,000 level: liquidity. Selling 118 ounces quickly at fair market value is not simple. Your local dealer might not have 10,000 in cash available that day. They'll need time to arrange it. Online dealers require shipping, insurance, authentication, settlement periods. You're looking at 7 to 14 days to get cash in hand. Oh, and here's the part nobody tells you. During volatile markets, dealers protect themselves by widening spreads. When silver spiked to 120 in January, physical premiums went to 15-20% above spot. When silver crashed to 72, dealers were offering spot minus $5 to $8 because they didn't want to hold inventory in a falling market. So your market value depends entirely on whether you're buying or selling and what the market is doing. Know your exit channels now, not during a crisis. Identify 3 dealers, 2 local, 1 online, who can handle your volume. Call them Monday. Ask their current buy price relative to spot. Understand their payment timeline. Do this before you need it. If you hold SLV, you're holding paper silver custodied by JP Morgan, priced using COMEX benchmarks, and governed by trust documents that include cash settlement provisions under extraordinary circumstances. At $10,000 of SLV, approximately 118 ounces equivalent, your position is liquid. You can sell any trading day. Settlement in 2 days, 0 counterparty risk under normal conditions. But these aren't normal conditions. SLV saw $3 billion in redemptions in January. 29 million ounces exited year to date. The trust currently holds 560 million ounces. That represents 62 to 70% of all identifiable silver in Western vault systems. The custodian, JP Morgan, simultaneously operates as the largest COMEX silver deliverer and holds one of the largest concentrated short positions in silver futures. During normal markets, that conflict doesn't matter. During delivery crises, it matters enormously. Your specific risk as an SLV holder, paper physical divergence. If COMEX paper price tracks lower while physical silver prices stay elevated or rise, your SLV shares will track the paper price down. You'll show losses on your screen while the actual metal backing your shares gains value. This divergence is already happening. Shanghai physical, $94 to $95. COMEX paper, $84.40. SLV tracks. COMEX, not Shanghai. If that divergence accelerates, if COMEX goes to 70 while Shanghai stays at 90, SLV holders lose while physical holders gain. Same metal, different outcome. If you hold PSLV, your silver is fully allocated at the Royal Canadian Mint. Published serial numbers, independent verification. Your counterparty risk is against Sprott and the Canadian government rather than a bullion bank. But PSLV has a different vulnerability, premium to net asset value. PSLV often trades at a premium to the value of its underlying silver, sometimes 2%, sometimes 5%. If you bought at a 5% premium and volatility causes that premium to collapse to zero, you lose 5% instantly regardless of what silver does. At $10,000, that's $500 of value that just disappears. If you hold futures contracts, you're in the highest risk category. Each COMEX silver contract represents 5,000 ounces. At $84.40, that's $422,000 notional. Current maintenance margin after the latest hike, $23,000. You're controlling $422,000 with $23,000 of capital. 18 to 1 leverage. A 5.5% adverse move wipes out your entire margin. January 30th's 31% move would have generated $130,000 in losses per contract. If you're holding $10,000 in futures, a fraction of one contract, your leverage exposure is extreme. If you hold mining stocks, you're exposed to silver price plus operational risk, management risk, jurisdictional risk, cost inflation, and equity market risk. Miners typically leverage silver moves 2 to 3 times. 5% silver move equals 10 to 15% miner move. At $10,000, a 15% swing is $1,500 in gains or losses. Manageable at that size. But you need to know what you're actually holding. Which companies? What are their production costs? Debt levels? Where do they operate? What's their hedging policy? A miner that hedged 50% of production at $60 silver will massively underperform an unhedged miner if silver spikes to 100. That difference matters. About 75% of you watching aren't subscribed. If this breakdown is showing you risks you didn't know existed, hit subscribe now. Drop a comment. Which structure do you use? Now, question 2. Question 2. What price did you actually pay? Your cost basis is the foundation of every decision you'll make this week. It determines your tax liability, your risk tolerance, your psychological anchor during volatility. Let me show you 3 different holders with the same $10,000 position, but completely different situations. Holder A bought 118 ounces at $25 per ounce. Total cost, $2,950. At $84.40, their position is worth $10,000. Unrealized gain, $7,050. That's a 239% return. They're massively profitable. They can handle volatility. The 20% pullback still leaves them up 175%. Holder B bought 118 ounces at $75 per ounce. Total cost, $8,850. At $84.40, their position is worth $10,000. Unrealized gain, $1,150. That's a 13% return. They're profitable but fragile. A single bad day, a 12% drop, erases their entire gain. Holder C bought 118 ounces at $110 during January's spike. Total cost, $12,980. At $84.40, their position is worth $10,000. Unrealized loss, $2,980. They're down 23%. They're psychologically anchored to their purchase price. They're hoping for recovery. They're vulnerable to panic during further drawdowns. 3 holders, same ounce count, completely different mental states. Which one are you? Write down your cost basis right now. Every purchase. Calculate your average. Know your unrealized gain or loss. Understand your break even. Understand how much drawdown you can absorb before profit becomes loss. This isn't optional at 10,000 plus. This is the foundation. Question 3. Do you have a written plan for both scenarios? March delivery starts Thursday, first notice day, the moment when paper positioning meets physical delivery demand. Current open interest, 340 million ounces. Registered inventory, 98 million, 3.4 to 1. That creates mechanical risk in both directions. If delivery demand exceeds expectations, price spikes violently. The market reprices to pull metal out of strong hands. That's the bullish case. If contracts roll forward and delivery is manageable, the paper system survives. Price retreats as the crisis narrative fades. That's the bearish case. Both are possible. Your plan must account for both. Get a piece of paper, write 2 scenarios. Scenario A, silver spikes to 95 plus on delivery pressure. What do? Sell 25%? 50%? Hold everything? Add more? At what exact price do you execute? Write it down. Scenario B, silver drops to 75 as delivery fears ease and margin pressure continues. What do? Buy the dip, set stops, hold tight. At what exact price? Write it down. Having both plans written before the market opens removes emotion from the decision. And here's the first test. Sunday night, Globex open at 6 p.m. Eastern. Historical pattern. Silver opens below Friday's close 64% of the time on Sundays. Average first 30-minute drop, 0.8 to 1.2%. At 84.40, that's 83 to 83.40 before full liquidity returns. If you're holding 10,000 in futures or leveraged positions, that $1 drop represents $120 in mark-to-market losses in 30 minutes. Can your margin handle it? Have you calculated it? If not, do it now. Question 4. Is your silver actually insured? If you're holding $10,000 in physical silver at home, ask yourself, is it insured? Here's the brutal truth most people don't know. Standard homeowners insurance covers precious metals up to $200 to $500, period. If you have $10,000 in physical at home, you have $500 of coverage. That's a 95% gap. If you have $50,000 in physical, you're 99% uninsured. House fire, theft, flood, natural disaster. Any of these events equals total loss. Call your insurance provider Monday morning. Ask specifically about precious metals coverage limits. Ask about scheduled personal property endorsements. Most insurers will extend coverage, but you need to add it explicitly. And they'll require documentation. Photograph every bar. Serial numbers visible. Photograph every tube of coins. Mint marks visible. Store those photos in a secure cloud location separate from your physical storage. Keep purchase receipts organized by date and amount. If you hold in a private vault or depository, verify the insurance provisions in your storage agreement. Most reputable depositories carry full insurance, but verify the amount, the insurer, the deductible, the claims process. If their coverage has a per-client cap and you exceed it, you're self-insured above that limit. This isn't exciting. It's not about COMEX delivery drama or Shanghai premiums. But at 10,000 plus, proper insurance protects against risks statistically more likely to hurt you than any market event. Market volatility is temporary. A house fire is permanent. Question 5. Can you actually sell when you need to? Liquidity test. It's Monday 9 a.m. Silver just spiked to 95. You want to take profits on $20,000 worth. Can you do it? How fast? At what price? If you hold physical, your local dealer needs cash. They might need 2 to 3 days to arrange it. Online dealers require shipping plus settlement, 7 to 10 days minimum. Meanwhile, silver could be back at 80. If you hold SLV, you click sell and have cash in 2 days. But if paper diverges from physical, if COMEX shows 95 while Shanghai shows 105, you're selling at the COMEX price. You're leaving $10 per ounce on the table. If you hold futures, execution is instant. But if you're leveraged and the price moves against you first, even briefly, you're margin called and liquidated before you can act. Know your exit channels before you need them. Identify who buys your volume, at what spread, with what timeline. This weekend, before Monday opens. About 75% of you watching aren't subscribed. If this is the most actionable silver breakdown you've seen, hit subscribe. Drop a comment. Do you have insurance on your physical? Now the weekend checklist. Your mandatory weekend checklist. Here's what you do before 6 p.m. Sunday. 1. Count your exact position. Total ounces. Total dollar value. 2. Calculate your average cost basis. Every purchase. Know your unrealized gain or loss. 3. Identify 2 to 3 dealers who handle your volume. Call them Monday to verify buy prices. 4. Check your homeowner's insurance precious metals limit. If it's $500 and you have $10,000 in silver, you're 95% uninsured. 5. Photograph every bar with serial numbers visible. Store photos in cloud separate from physical location. 6. Write scenario A plan. Silver to 95 plus. What do? At what price? 7. Write scenario B plan. Silver to 75. What do? At what price? 8. Write your absolute pain threshold. The price where you exit everything regardless of thesis. Every position needs one. Even if you believe silver is going to 200, you need a floor price below which you acknowledge your thesis was wrong, or the market's ability to stay irrational exceeded your ability to stay solvent. Write that number down. If silver hits it, you execute without hesitation. The purpose of the absolute floor isn't to predict where silver goes. It's to protect you from catastrophic loss in a scenario you didn't anticipate. 9. Write your 12-month target. $100, $120, $150. Having a target helps you evaluate whether intermediate volatility is noise or signal. If your 12-month target is 120 and silver drops from 84 to 75 this week, that's a 60% upside opportunity from the dip, not a reason to panic. Context from your own written target prevents emotional reactions to short-term moves. 10. Put the written plan in a drawer you can access quickly. When the market moves this week, and it will move, pull out that paper before touching your phone. Read your own words, written by your rational self during calm conditions. Then act according to plan, not emotion. Let me tell you why this written plan matters so much. In January, during that 31% single-day crash, I saw holders with $50,000 positions panic sell physical at the absolute bottom. They took spot minus $8 from dealers because they were terrified. 3 days later, silver was back at 90. They sold at 72. They locked in a 20% loss because they had no plan, no written threshold, no scenario preparation, pure emotion. If they had written down, I sell if silver breaks below 65, they wouldn't have sold at 72. If they had written down, my 12-month target is 120, so an $80 pullback is still 40% upside, they wouldn't have panicked. The plan protects you from yourself. And here's what most people don't understand. The biggest threat to your position isn't the market. It's you, your emotions, your fear, your greed, your inability to stick to a rational decision made during calm conditions. The written plan removes that threat. When silver drops 10% in an hour and your stomach is in your throat and your hands are shaking, you don't trust your judgment in that moment. You trust the judgment of your calm, rational self who wrote the plan 3 days earlier. That's the difference between holders who survive volatility and holders who get destroyed by it. Every data point I've referenced is publicly available. COMEX vault data through CME, SLV holdings through iShares, PSLV data through Sprott, Shanghai premiums through SGE, CME margin schedules through exchange notices, insurance policy terms through your provider. All verifiable, all accessible. If you own $10,000 or more in silver, you own a meaningful position in one of the most volatile markets on the planet right now. That position deserves real attention, real planning, real risk management, the same level of strategic planning, risk management, insurance coverage, cost basis awareness, and structural understanding that you would apply to any other $10,000+ investment. Now let me give you the final perspective. The holders who profit most from the next 30 days aren't the ones with the most conviction. They're the ones with the most preparation. Conviction without preparation is hoping. Preparation without conviction is hedging. Both together is how you survive volatility without getting destroyed. Let me be very clear about something. I'm not telling you silver is going to 100. I'm not telling you silver is going to 50. I don't know. Nobody knows. What I do know is that the next 30 days will be volatile. The conditions that created January's chaos are still here. March delivery is Thursday. 340 million ounces of open interest against 98 million registered. Sunday night opens in 36 hours. Historical pattern says 64% chance of opening lower. Chinese export controls are on day 53 with no precedent for reversal. Shanghai premiums are widening. Paper physical divergence is accelerating. Something is going to move, and when it moves, it will move fast. The question isn't whether you have conviction about direction. The question is whether you're prepared for either direction. Because unprepared holders get destroyed regardless of whether they're right about the ultimate direction. If silver goes to 150 but you panic sold at 75 because you had no plan, being right doesn't matter. If silver goes to 50 but you're holding physical with no insurance and your house burns down, being right doesn't matter. If silver spikes to 100 but you're in leveraged futures and got margin called at 85 on the way up, being right doesn't matter. Preparation is what allows you to stay in the game long enough for your thesis to play out. You have until 6 p.m. Sunday. 5 questions. Written plans, verified data, clear cost basis, proper insurance, known structure. The checklist is simple. Executing it before Monday opens is what separates survivors from victims. Do your own due diligence. Understand the risks. This is not financial advice. But based on everything I've shown you, the COMEX data, the delivery timeline, the historical volatility patterns, the structural vulnerabilities of each holding type, I can tell you this. If you're holding $10,000 or more in silver and you haven't answered these 5 questions, you're flying blind into the most volatile week of the year. And that's not a risk. That's recklessness. Drop a comment right now. Tell me, how much are you holding? Have you calculated your cost basis? Do you have insurance? Do you have a written plan for Monday? I read every single comment, and I'll respond to as many as I can. If you got value from this breakdown, share it with someone who needs it. Send it to anyone you know holding serious silver positions. Because most of them haven't thought about any of this, and they're about to walk into Monday completely unprepared. This is Mark from GoFinance. If you're holding 10,000 plus in silver, this weekend is critical. The market opens in 36 hours. March delivery is 5 days away. Everything you need to do now. Not Monday morning, not after the market moves. Now, stay sharp.